Hello, everyone. Dave and Tom Moore, the Exchange Bros, and it is September 16, 2025, and we're having a lot of fun just talking about a variety of AI things this morning. And I guess as we were talking, I started thinking about the presentation I gave at the CCM Global Conference years ago that was titled, "You Can Do What You Don't Know." And I think that sort of puts me in the state of mind I am this morning, a little irritated when I start looking at AI and the impact it's beginning to have on our industry, and I think it's really critical that people, when they work with Equity Advantage or IRA Advantage, they understand that we're working for our client, period, nobody else, and we're not going to send you anywhere unless we feel it's right for you, but we are not going to be sending you someplace because we're getting paid for it. But I think if you look at we've had discussions through the years just on this payment deal, and I know there's one AI-based company out there that's literally paying brokers to send them people. One, I think, you think about people's policies on referring, and a lot of people historically have said, well, I'm not going to refer one person, I'm going to refer three because I'm concerned about liability. Well, now how many times do you multiply the risk if you're actually taking compensation for sending somebody? And you as the consumer should probably be concerned about, well, why are they pushing so hard to go that way?
Yeah, and we've talked about this too. As far as these exchanges are concerned, there's really not enough meat on the bone, so to speak, to be giving out a referral fee to somebody that would be worthy of them taking on the risk to refer to a business that maybe has no time in the business. But yeah, that's certainly happening. I guess that's the world that we're living in now, and people are, maybe it's a new broker that's just hungry for some money, but they're willing to take on that risk of referring their clients to somebody for an exchange that doesn't have any experience in the business, and who's to say that business is going to be there tomorrow?
So if we look at an exchange company, and we've discussed through the years, and from our inception, we were sort of encouraged to put ourselves in a different sort of level as a facilitator versus an accommodator or intermediary. I don't know if you want to sort of make comments differentiating those things. But that was one of those big things from day one. We wanted to be a value add to people and their transactions, whether we're talking to brokers or anyone else. But when we start looking at who can actually take that position in a transaction, really we're paid a fee to turn somebody's sale and purchase into an exchange, without actually you having what I want, I have what you want, swapping. But you have any comments on that, and maybe just for the sake of the audience, who can actually who can actually structure an exchange for somebody?
Yeah. So yeah, facilitator is what you mentioned. We refer to ourselves as, and it really refers to somebody who is going to be taking a very active role in the transaction, whereas an accommodator will do that. They'll accommodate a transaction. They're taking a passive role, and I would say AI is going to be at the far end of being a passive accommodator for a transaction. Very passive role. You might have situations where there's only one or two people in a company. Who's to say with these things? But yeah, we've always taken on that role, wanted to be a value add, as you mentioned, to our clients, but also to the entire real estate community and the tax community. We've always been very education oriented in this, providing credit hours and doing seminars, presentations from day one. I don't know how many hundreds of presentations you've given over the years, but it's a lot. I'd say probably thousands. When you look at not only in person but all of the online, and our video library is pretty extensive. I imagine that a lot of the AI answers that are retrieved from people these days are taken from our information. Yeah, I think that our website has been out there since 1991. We're 1031exchange.com. Everybody asks, well, how'd you get that? When we put that website up, I think if you Googled 1031 exchange, well, it wasn't Google at that point in time. What was it? Was it Yahoo or?
It was Yahoo. No, it was. Yeah, it was Yahoo because Yahoo all of a sudden it was Googled by or was powered by Google at one point. But I mean, Netscape and AOL.
Yeah, AOL.
American
I was
Online.
thinking AOL. Yeah. So it's when we have clients that have AOL email addresses, it's always very interesting. But where was I going with that?
We're just talking about who can be an accommodator and sort of the difference between our different sort of arenas when we talk about being we talk about a noun versus a verb, right? I mean, as far as accommodate or intermediary versus facilitate. And I think one of the things, so I had a call. So if you've got property, you're a broker, let's say, and you've got property you want to get in front of our people. I mean, we used to have, remember, people would just be sending us stuff, faxing us sheets, right? And we'd have those things, and it would always go stale. Nobody would tell us it's sold. And we put that post 1031 site together, years ago to accommodate people's needs and desires to get asset product in front of people. But you and I get calls all the time from investment sponsors looking for 1031 money. And I think that what you need to look at, if you're putting projects together, you want to build something out, or you're looking at funding some investment, and you're looking for 1031 money, I think it's one of those things where you really got to be cognizant of the fact that 1031 money is very impatient and inflexible. And the reason I say that is you've got a finite period of time that things have to happen. You've got value and equity requirements that need to be met, and you've got ownership requirements too. I mean, and one of the biggest issues you and I deal with day in, day out is ownership, whether it's a direct deeded ownership in something or a partnership interest, which is specifically prohibited from 1031. But I think the conversation that, and it's one of those things that I have a lot of fun with, and Tom's comment about presentations. The first probably half dozen years we had the company, both of us spent every day, all day on the road going, spreading the gospel on 1031, and both of us were doing exchanges and presentations all the time, and we had people in the office handle that stuff. But when you start looking at these people call up and they say, well, hey, I've got this or that, I want to get in front of your people. Something I'd like you be aware of is that qualified money, IRA 401k funds, which we unlock via our sister company IRA Advantage, is a much easier form of money to use to make things happen. And through the years, and I'm just going to shift gears real quickly, but I mean, you've got a number of clients you've worked with, builder developers, where you've effectively helped them create investment funds that fund all their projects these days. And that's sort of that funnel of money that I think is a much more easily used source of funds. And one more reason I like it is that 1031 money, so many of our clients are mom and pops that live off that money. So one of the things that DSTs, Delaware Statutory Trust investments, are nice for is somebody that's selling rental houses, a mom and pop that have had those things, they need the cash flow off those things. And by buying a DST, they can have that cash flow virtually uninterrupted, right? I mean, they can make the purchase within days of the sale. They can have a check in the mail maybe a month later. So they really don't have that go away, where if you're some builder developer, or you've got a fractional interest in some property you want to sell, but it's sort of a value add situation that's going to take, there's a longer time horizon, that income goes away. Where my experience is with the qualified money, the IRA 401k funds, people can't touch that money until they're 59 and a half, or they're going to pay a penalty, or at 73 when they have to take RMDs these days. So you've got a situation where that's much more patient money. People are more concerned with what it's going to be at at some point in the future than they are what it's doing today. Any comments on any of that? And I just spewed a whole bunch at you, but hey.
No, I think it's a good point that because most of the people that we are setting up their retirement dollars for, whether it's IRA accounts or 401k plans, most of that is the majority of it's going towards some sort of real estate related asset. And whether they are, I guess you got a lot more flexibility in how you are using that money too, because you don't have to buy the direct deeded title to a piece of property. You don't have to get deeded title to a property for your retirement dollars where you would with your 1031. So it opens up another way to invest, whether you're going into a fund or buying into a partnership interest in an acquisition of a property, or acting as a lender. We have a great number of people that have done very well acting as, or using their IRA money to lend money to builders, developers, and so it's not in certain situations they might need some cash flow off of these investments. With 1031s, the investors don't always have cash flow on the properties. Same thing might happen with an IRA investment, but with the IRA, people think that initially they can't receive any benefit as far as a monthly income is concerned. That's not the case, because they can certainly have their IRAs set up where they are getting monthly cash flow. It's just going to be through distributions, but they can have those set up so that they happen on a regular basis too. And if they are past 59 and a half, there's no penalty. They're just going to pay ordinary income tax on it. So people will do that. They'll buy into an asset and they'll have it set up so that whether it's on a quarterly basis, semi-annually, annually, they can have it all set up so that they're getting a set income off of those investments as well.
I think your point, do you want to be the debtor of equity in a transaction? And each of those things is going to have an up or a down. I mean, rarely is there a situation where this is absolutely the right way to do it, right? I mean, you really, once again, you don't know what you don't know until you start digging into it. And I think that, that's where the stories come in, and understanding. For example, you think, and once again, we've sort of shifted out of 1031 into qualified money a little bit, but you think about, the guy that calls up and says, hey, I want to self-direct my retirement account. I want to go buy an apartment building because I need more cash flow. Well, one, you're not the owner of the building, and that cash flow, like you said, can only be taken as a distribution from the retirement account. But you're looking at these things like, okay, what's the highest best, if we were looking at qualified money, any money really, what's the highest best use for it? And how's it going to work? And owning things, you think about the guy with the apartment building that has the laundromat in it. They love the laundromat because it's a nice value add for the investment that is the apartment building. So they go buy a laundromat. Now they've got unrelated business taxable income because the laundromat's a business, not an investment. So it shifts. And see, these things you only learn through experience and seeing it and applying it in the transactions through time. But it's so easy to sort of shift gears on stuff. And back to AI with, okay, how long do you have to hold a property qualify for 1031? Well, there's no answer, right? I mean, even if a related party transaction, the fine print says unless there was no intent to avoid tax. Well, what's 1031? Is that avoidance or deferral? I'd say it's deferral. Sheila's my wife. So Sheila and I watched Meet Joe Black the other night, and it's a neat movie. It's sort of a tearjerker, obviously, for a variety of reasons. If you haven't seen it, it's good. But at the end, I had forgotten that the answer at the end of the day, the talk, was Brad Pitt was death, and he joked about the only sureties in life, death and taxes. He played the IRS guy at the end of the show, is how they sort of disclosed everything. But you start thinking about stuff and you think, okay, well, death and taxes and that tax consequence, we say it all the time, tax exposure is one thing, taxes owed is quite another. and whether you're going to have the exposure or what you're going to owe, you're going to be subject to things based upon the experts you're working with. And I think that we like to include ourselves on that team, but good competent tax and legal people, you're not paying for an opinion. You're paying them for an opinion, not paying them to learn on your behalf. I think that's really critical. And it seems to me, I mean, I don't know if you like comment, I mean, 1031's over 100 years old at this point, and there's a good number of tax and legal people coast to coast that understand 1031 pretty well. But when we start looking at the retirement accounts, I mean, there's not many that we work with that really understand this stuff.
Yeah, and your comment about the tax and legal, if the big question with the 1031, or one of the big ones, should always be, do I need to do an exchange? Do I need to exchange this year? What's my tax exposure going to be if I don't, or if I do? And it's a question that cannot be answered by AI. You might be able to plug in dollars or sales price and your basis, if you even know that. Most people don't. Most people think that their basis might be the cash they've got, or the equity in a property, or that they think that that's what they're going to get taxed on. But if they ask AI, should I do a 1031 exchange this year, what are they going to get as an answer? It doesn't know what their situation is for this year. It doesn't know what might have happened last year. So they do need to get their tax people involved and ask these questions.
Well, you think about our website. For how many decades has our website had a capital gains calculator on it, right? But that's calculating the gain on that asset. That doesn't mean you got tax liability. I mean, you've got loss. That's where you're going to work with your tax people and your financial people before years in. You don't want to talk. Well, you want to talk to your CPA anytime before filing, but you're going to talk to them anytime you contemplate a sale. You're going to talk to them before years end. You're going to talk to your financial advisors. Maybe you have gain. 1031 is not all or nothing, so maybe you're going to have some gain here. Exposure is one thing, odes another. So you can offset the gains with losses, and that's where AI does nothing for you. It doesn't understand anything about your life. It can calculate what's happened there, but it might make an assumption. Let's look at depreciation. Well, you should have taken it, therefore you did. Well, okay, so you didn't take it. What's it going to say? Or maybe you took it, but maybe who made the allocations to improvements? Maybe you're doing cost seg, maybe you don't. I mean, there's endless things there that can skew those numbers. You think about that gal, you remember, this is probably 20, 25 years ago. You got a call, you were dealing with a gal that you started asking her about her basis, and she had gotten the property from her incarcerated husband, who had gotten it from his incarcerated friend or something like that. Remember? So, I mean, and when you gift a property, I mean, you've got a transfer of that basis. Remember that?
No,
I do. That's because I talk all the time.
I should.
Blah.
No, I know
Yeah.
you're jogging my memory a little bit there,
But I'll never forget that. We just started laughing because she had absolutely no idea what the basis was.
yeah. And again, when I started, I think that's not unusual. People don't know what their basis is. I got an email this week, actually last week, from a long-term client that's done quite a few transactions with us over a number of years. And, I think that they're trying to, I don't know if they've shifted accountants or what, but they're trying to probably rebuild what their basis was in their current properties. And they're going back and saying, can you provide us with a list of all the properties that we've done through the years, because we don't know which ones we've exchanged, and you probably do. And so it's and that happens a lot with people. They get into a transaction, whether it's their first exchange or it's one in a string of exchanges. They don't know what their basis is, and they're not comfortable with their current tax advisors. They've got a new tax advisor, and they're trying to get up to speed as far as where they currently are with basis and properties. But it all comes back to AI is not going to know this stuff. And that is one of the biggest questions that is going to help people to make the determination on whether or not they need to do the exchange, because they might get all kinds of answers on how it's done, and then they don't know that maybe they did not need to do the exchange this year.
And there's an opportunity cost to the exchange too.
Sure.
You got a finite period of time. You got to make it happen. You got value requirements. Maybe you don't want to do all of that, and you've given up the money for a period of time. But just for the sake of the conversation basis, what's your basis in the property? It's a purchase price plus capital improvements minus depreciation. Purchase price isn't always a purchase price. So you've got, if it's a 1033, we had a question on 1033 involuntary conversion. That's basis carry forward. 1031 is basis carry forward. 1034, the old residential rollover from the 90s, that was a basis carry forward. If I give you my property, your basis is what mine was. If I die, you inherit it, you get step up. All those things change what's happening there. And then, back to Tom's point, they don't know. Well, capital improvements. Purchase price plus capital improvements. Well, yeah, I did all this work, but I wrote it all off. Well, you expensed it, so that doesn't impact. So what should you have done when you first bought the property? Who made the allocations to improvements? Are you using cost seg? I mean, what exactly should be taken on depreciation? What's going to work for you? And I mean, it's just endless, this sort of variation that can happen there. And so often we're dealing with people that really don't know what their basis is. So, and it comes back down to, you're going to get what you pay for. And we always joke, since we're both certified dive masters, but you start looking at scuba diving, okay? So yeah, to the person who wants the cheap exchange, I'll just say, well, you're going to go scuba dive. Do you want the cheap regulator, or you want the best one that's going to keep you alive, right? I mean, you can have brain surgery. You want to, the cheap person or the person that's going to get it done right. There's something called decision fatigue these days too. Yeah, you start looking. Yeah, exactly. And you think about, okay, Dad, as doctors, it was forbidden for them to actually even advertise in the old days, right? They just had to be very good at what they did. And now everyone's advertising. So you got people that are buying up clinics, and well, they're huge. Does that mean they're good? I mean, that's two different things. But you just sort of start looking at these things, and it's like, think about the cost, number one, of an exchange. If you look at a settlement statement, it's typically one of the smallest items on there. And there are actually title escrow companies that will charge additional fees because it's an exchange, and really all they're doing is adding another person, another company to the settlement statement. There's really not much more work at all that they're doing, but they'll charge half what the exchange company gets just because it's an exchange. It's really sort of a crazy thing, and you start looking at all the different fees that are there. But the exchange costs are typically not very much in there. You have few $1,000 for something to get done if it's a normal transaction. If maybe it's an improvement or reverse, it might be a lot more. But
yeah, and you're probably the same as me. If somebody ever calls up and asks us, if it's an agent or somebody calling up and asking, do you guys pay referral fees? We'll tell them no. We won't charge or we won't pay referral fees. We can't do that. Don't think it's ethical. And what we will do is we'll make you look good. If you're referring a client to us, we will make you look good, and they will trust you, and maybe you'll get their next transaction. So always look long term. Don't look for the short term.
And I think the same thing applies on the buy side too, to these different companies or brokers that want to pay us, right? And our response is typically, it's like, look, we don't want anything other than for you to take care of our client. Because what good is an exchange? I mean, what good is it to you to do an exchange into something that goes away? That's the bottom line. And you don't want to just buy stuff because. You don't want to, if you're doing an exchange, you should be, we were always told it wasn't a tax or legal decision, it's merely an investment decision. And you need to be cognizant of that and really figure out what you're doing and take the time to rationalize what you're doing with this and where you really want to go. And I know the conversations we really encourage our coordinators to have, not our coordinators, well, our coordinators, but also our intake people, the people that are consulting, prospective exchangers. If they don't need to be doing exchange, we want our people to tell them that, and we want to rationalize the transaction. We want to make sure that they're doing it because it makes sense for them, and that's why a phone call is so great, because you can sit there and dance and be the keyboard warrior back and forth for minutes, hours, days, and not get where you want to go. Where a conversation in a half hour can give you just endless information and guidance, hopefully, to keep you out of trouble.
Yeah, and real quickly on that note, I was just thinking when you're saying that, we've got a lot of people that will call in and they, they have a need to take some cash out of a transaction, and which is totally fine. They'll just end up paying taxes on that. But there are certainly times where it makes sense for them to still do the exchange, but then others where they think, well, I'll pull the money out and maybe I'll defer the rest of the taxes, maybe not. But there's always times when people are pulling money out where this exchange still makes great sense if they've got low basis, but other times where they'll be pulling out more money than what they're even paying on taxes if they just sold it. And we'll flat out say, definitely talk to your CPA about this, but it doesn't make sense for you to do an exchange this time. I think we had a couple of those last week where somebody was going to pull out about $150,000 out of a deal, and their basis was such that it didn't make any sense to do the exchange.
So that money coming out is boot, and the boot exceeded the gain. Therefore, there's no benefit to the transaction.
Yeah, it exceeded the gain, or it was really close. And maybe they're looking at only a few $1,000s benefit to doing the exchange if they do that. Does it really make sense? Or certainly this time of year, a little bit earlier on, they might have a situation where, okay, I want to pull some cash out. Then we'll have that conversation with them. Okay, you can do so. It's going to be taxable to you, but do you need it right now? Do you want some of it right now? Do you want some of it later? Which would be maybe next year. And so you can certainly, with a little bit of planning, you can have that as a 2025 tax event, a 2026 tax event, or split where it's some in each.
So with that said, one, I'll have a comment, and then I got a question for you. One, the person pulling 150 out, that's 150 in boot. You think, okay, I need 150 to go do this, but really you might have another 50 on top of that in tax. So now it's worse that you did the exchange. You've got this boot and tax liability that now you don't have the 50 to pay the tax obligation. So you pull 150, you got to have another 50 to pay the tax. Now you got 200, which adds another 10 to 15, and it's just a problem. So with that said, if somebody wants to pull money out of a transaction, one, when should they be thinking about it? But two, what opportunities do they have? Let's say if I do a cash out refi pre-sale versus cash out refi after acquisition, if that's the mechanism I want to use, or I'm just going to pull money out. If I want to just pull money out via refi, how far in advance should I do that? I mean, what's via afterwards, and I mean, what conversations do you typically have?
Yeah, as far as the refis are considered, you wouldn't want to do it in anticipation of a sale taking place, really. So you don't want to have your property on the market for sale and then pull money out of it. If you did that, the IRS could treat it as though you had pulled money out of the exchange transaction. Just look at it as a step transaction and end up with taxes on that money. Same thing on the acquisition. After you've acquired a replacement property, as far as pulling money out afterwards, there really isn't going to be any set time period. We'll usually tell people if you can do it in a different tax year, great. If not, then there should be maybe something else has changed, but it can't be your intent at the time that you acquire the replacement property. You're just going to buy it and then go out and find somebody and refinance the property. If somebody buys a piece of property and then there's an interest rate reduction that wasn't expected or something like that, that might make sense. Or if they've got some improvements that were unexpected, they've got to go out, and that might be a good reason to do it. I think the IRS is also going to look at it. I don't know if I have a test case for this, but we've always kind of had the opinion that if you did acquire a property and then suddenly there was a need to pull money out of it as a refi, just to put money back into it. You've got some improvements. I think they'd probably look at that differently than if you pulled money out and went out and bought another property or went out and bought a car or something like that. It kind of comes down again to what's your intent from time to time.
So once again, so if you ask AI, and I haven't done it, but if you ask AI, say, okay, can I do a cash out refi, predisposition? I'm curious what the answer might be, but if it says, well, no, typically we're going to say if it's on the market, don't do it. Ideally, it would be done a certain period of time before you're ever putting it on the market, or you've got a reason. Maybe you've got the current loans expiring. Now you've got another reason to justify what's happening there. But, normally we would discourage somebody from pulling money out immediately predisposition. But in a reverse exchange, there are times where that's the best source of funds and they'll do it. And in that situation, what we're looking at is, back to intent in 1031. And it's like, okay, if you're taking the money, go buy a boat, take a trip, do something like that, then you've got a poor intent. You're trying to pull money out without having the tax obligation. If you're doing it via reverse, we're going to say, okay, for total deferral in exchange, you have to satisfy what we call the napkin test, which says a cross or up in value and equity between the relinquished and the replacement property. So that cash out refi in a reverse transaction, if you look at the property pre-refi and post-exchange, and you can track all that money forward, you can easily say, well, yeah, I did do that cash out refi predisposition, but you can clearly see all money has been tracked forward into the replacement or replacement properties. In that situation, you're taking a situation where normally it would be a no-no, and now it's okay. So what answer do you get if you just want to be the keyboard warrior?
Yeah. All your equity is going straight into the replacement property. Usually it doesn't even go into the person's hands in these situations.
And now we're feeding AI with this conversation, but that's okay. So anyway, I always enjoy these conversations with you because we've been doing this for a while, and I think we have some pretty entertaining stories that we hope you guys in the audience find entertaining as well. But it's an interesting time that we're in right now, and lots of changes, and I'm just going to sort of throw out there, hey, you're going to get what you pay for, and we've said that before today.
Yeah, and again, as we alluded to earlier, I think that AI certainly has its place, and you can get some good answers. We've asked it a lot of questions, and a lot of times we'll go, yeah, that's a good answer. But again, everybody's transaction is different. Everybody's transaction is different. Everybody's tax situation is different. And without knowing somebody's individual tax situation, AI is just generalizing. That's all it's doing. And that's super important to realize that they're not giving answers that are specific to your situation.
Well, in today's world, we've had like prepaid legal was out there, LegalZoom was out there. You've got TurboTax out there. You got a whole variety of things out there. You got tax preparers versus CPAs, and other tax attorneys, all different levels at all different spaces in the investment and tax and legal worlds, and everyone's got a place, or all these companies have their place. It's just that, as I said before, you can do what you don't know, and you don't know what you don't know, and until you start really, understanding you've got that background in it and the experiences, and you think about life, and you think about, unfortunately, the situation where you learn the most is, I always say I'm happy to learn, tired of being taught. I don't like getting kicked in the head that often anymore. So you want to look at it, understand those basics, and I know that we have, through the years, we encourage people, even if you're working with other companies, you got questions, concerns, you need some help, we encourage people to call, because we enjoy this, and it's one of those things where it's not a business where I really feel like we are selling anything. We're just providing opportunities and solutions for people. And that's what's been fun and very rewarding through the years, to see some of our clients that we've worked with for decades now that have started with nothing and have ended up realizing a very nice lifestyle out of their trading of properties via 1031. And now, like you said earlier, with the retirement accounts, now that we've had that business in place for almost 20 years at this point, the number of people that we work with in that space that have said, hey, thank you so much for what I did. Best thing I ever did, X years ago, is to do this. And I think that, the neat thing about that IRA 401, the qualified money space, is that the 1031 is 100 years old, retirement accounts for the mid-70s. We look at the amount of information that's available for people in the retirement world, and it's just really not out there. And I think that it's really one of those things where retirement account's supposed to be there for you in the days after you're retired, obviously, and to have people with the ability to actually invest in what they know, when the only people that can invest in what they know in Wall Street are Wall Street and are politicians, it seems like. Everyone else is going to be, ask Martha Stewart about this, as I always joke. But, insider trading's a no-no. But if you're a mortgage broker, you want to take your retirement account and make loans, buy notes, hey, you probably have an advantage. Why not do it? You're a real estate broker, same situation. You're a gold, silver dealer, you crypto. Hell, I think, crypto, probably the ideal way to own crypto is with a retirement account. And our accounts allow people to do those things. But I've just really enjoyed, working with you through the years on these things, and it's back to providing opportunities and solutions. And I think that's what really has been fun for me. And I think I'm not going to speak on your behalf, but I think for us through the years.
Yeah. Yeah, and I was going to say that there's a lot of professions that are going to be undergoing a lot of challenges from this whole AI thing, and the tax community, same challenges we have, because a good tax advisor is going to be asking a lot of questions of you, and because again, people don't know what questions or what they should even be telling their tax people if the questions are not asked. So.
Hey, AI, what's my tax person supposed to charge?
Yeah.
And you think about that, Tom. How many times we hear somebody say, well, gee, I don't want to pay, so-and-so or this person for tax work because they're so expensive. And I think they're really selling themselves short. It's like the fee you pay for the exchange. Well, what's the ultimate outcome of the exchange? What do you ultimately realize through it? When people focus merely on the cost of, let's say, tax work, they're missing the boat. I mean, because calculating tax exposure on a given situation is one thing. Actual taxes owed at the end of the year is something else. Or you think about planning a sale, whether it's a property or a business or any other asset, to actually sit and plan it with your tax people. Tax and legal people really is critical to your ultimate, result.
Yep, really is. Yeah. Yeah, and I think that I know this whole question about how much we should be charging, and you'll certainly get different opinions from different people, and we've got clients that we've done transactions with for 20, 30 years that will just say, you guys don't charge enough, and it's like, well, we'd sometimes like to charge more, but
it is what it is.
Yep.
So, yeah, I don't, as far as conversation today, I think we've done a good job with what we wanted to cover. We've got other topics on this sheet, but we're going to leave it for another day, I think. Any other comments you'd like to make?
Just that this whole thing with AI, it's going to be a conversation for a while, I think, now, and we will certainly share our experience with it because we're in the industry, and again, there's certainly some good things. It's not going to substitute. It's not going to be a substitute for an actual conversation with somebody where you can have this give and take. And I don't know that it's going to be that for anybody that has much of anything going on in their life. If somebody if they've got one piece of real estate and they are doing their first transaction, then maybe they can use TurboTax, and maybe they can. I don't want to push anybody towards an AI-based 1031 company, but maybe it'll work out for you. But at the same time, is it worth it? Is it worth it to the client? Is it worth it to a broker to have them use these people?
Is it worth it to that broker to get paid to push that person that way?
Because any company that is an AI-based company is going to likely be very new, and they probably don't have people that have been in the business for any duration, because most people that have been in it for any duration are not wanting to go that way. For good reason. For good reason.
So, Dave and Tom Moore, the Exchange Bros, and thank you so much for joining us today. We really actually enjoy doing these for our audience. And if you've got topics, questions that you'd like addressed, please don't hesitate to reach out to Seymour at 1031exchange.com, Seymour, Moore, at 1031exchange.com. And we love to get some content up there to help you get where you want to go. So it's not the deal, it's the destination, and we want to help you get there. So thank you very, very much for the time today.
Yep. Thank you very much.
Take care. Bye-bye.